Hey cousins, back with another video. On today's video, we'll be talking about the trade blueprint from trend to execution. Trading is often misunderstood as the game of predictions, but the real skill lies in understanding concepts. Each concept we've covered so far, from trend to structure to liquidity, kill zones and more, are not isolated lessons. They are puzzle pieces that only make sense when assembled into the complete picture. This episode is about that bigger picture, blending every concept into a framework that transforms analysis into execution. In this episode of Wicks and Wins, whether you're a beginner, intermediate trader, this session will sharpen your edge. We are diving deep into the core mechanics of the market: trend, structure, liquidity, kill zones, and more. Understanding these elements is what separates reactive traders from those who consistently anticipate market moves. We'll break down how trends form, how identity shifts in the market structure, and why liquidity is constantly being hunted by institutions. You'll also learn how kill zones, those specific time windows when high probability moves happen, and how they can give you a massive edge in timing your entries and exits. By the end of this session, you not only be able to read the market with clarity, but also start spotting precise points where smart money is active, helping you make more informed decisions. This isn't just theory, it's actionable insights that can transform how you approach every single trade. Come with me. Before we proceed, I would like to guide you through certain terminologies like the role of the trend. The trend is the silent partner of every trader. It doesn't shout, but it guides every decision. Trading against it often feels like swimming upstream, possible but exhausting and unsustainable. When you respect the trend, you place yourself in alignment with the market's natural rhythm. Top-down analysis helps clarify this rhythm. The higher time frame shows the story, while the lower time frame reveals the details. Together, they remove the guesswork and create bias. And your bias is your compass. It tells you whether to look for buys, sells, or sit on your hands and stay patient. The next I would like to touch on is volume and candles as a market language. This is very, very important for you guys to know. Once direction is clear, the next question becomes intent. Does the market truly want to continue, or is it luring traders into a trap? This is where volume and candlestick reading provide answers. Volume exposes commitment. A strong push with conviction reveals the hands of smart money, while low volume moves often expose retail manipulation or false breakouts. Candlesticks or candles, on the other hand, whisper the same message but in a visual form. Wicks, engulfing bodies, and sharp rejections give texture to market intention. Together, they act as a translator, turning market noise into readable language. The next I would like to touch on is kill zones. I know throughout our episodes I've talked about kill zones over and over again, but they are actually that important. That's why I keep bringing it up. So this is where timing meets opportunity. Markets don't move with the same energy throughout the day. Certain times carry weight, and this is where kill zones matter. The Asian session sets the tone with a range, usually a range. London disrupts it, sweeping liquidity and establishing momentum. New York adds confirmation of either a reversal or a continuation. Within this window, liquidity is targeted, structure is broken, and opportunities arise. When your analysis aligns with the right kill zone, probability shifts in your favor. You're no longer trading at random, you're trading when the market is designed to move. The last that I would like to touch on is structure, confirmation, and the art of entry and exits. Bias alone is not enough. A trader must still wait for the story to unfold. What does this mean, you might ask? This is where concepts like break of structure, change of character, break of the candle confirmation comes into play. They act as checkpoints. For example, a break of structure confirms continuation, a change of character signals reversal, a break of candle validates the precision of entry and also volume sometimes. By waiting for this confirmation, you filter out noise and align your execution with genuine market intent. The last but not the least, which is extremely important, is to reward, the silent guardian. Even the sharpest entry means little without risk control. This is where the risk to reward framework step in. It ensures that your potential gain outweighs your potential loss. By structuring trades around liquidity sweeps and natural price targets, stops and targets are no longer arbitrary. They are strategic, aligned with the story price is telling over time. After a while, it's not accuracy alone, but it builds consistency. But the discipline of risk and reward is what will take you far in this game. On this episode, I would like to show you on the chart everything I've been covering, so you can follow along and learn some of these concepts alongside me. So come on, guys, while we go to the chart. See you on the other side. So guys, the first concept I want to run you guys through is trend. I'll be taking this case study on Bitcoin, as some of you know it as BTC USD or USDT. As you can see, since half the year, 22nd of June, it has been in a consistent uptrend, right? And now this is all-time highs. So already, you know, this is what I call like the top to down analysis, because this is the external range. Remember from our previous episode, this is the external range, this is the external range. So you are only trading within this internal range on Bitcoin, but you know, based off of your knowledge of the higher time frame, that Bitcoin is bullish. So looking here now, this was a break of structure, major break of structure from this point. Price came back to mitigate from this point. So this was 1st of September, right? Price mitigated this other block that was created on the 1st of September. So you should know that, okay, going into the smaller time frame, you shouldn't be looking for sales. You know, that's what I meant by swimming upstream or swimming against the trend. It always doesn't work out. You know, it's better to follow the trend or follow maybe a retracement into like smaller levels. That if you are going to sell, it should be like a retracement, knowing the bigger picture. That is why the higher time frames are very, very, very important, right? So as you guys can see now, if I go down into the smaller time frames, let's say the 4 hour, for example. Perfect. So on the 4 hour, coming down now, I know I'm close to all-time highs, or even at, okay, this is all-time highs, 126,000 on Bitcoin, right? Price reacted off this FVG and is going up. By next week, I expect price to even break even above this and create a new all-time high. And this price is still bullish, as we can see, because we already understand the trend direction. That's why a trend is extremely important, guys. So on the next one, I will cover 3 different terminologies, and they include the volume and candle. I'll show you how volume and candle work together on the chart. I'll show you how kill zones affect volume, and how structure, confirmation, and how to actually time your entries and exits, together with deciding what you want to risk on a trade. That is risk to reward, which is a very integral part of your trading journey. You guys need to pay attention to the next part. So come with me as I show you through. So guys, for today, or for this example, I will be running you guys through my trades, my personal trades on GBP USD, you know, to explain all of these concepts thoroughly, right? Today I analyzed a trade on GBP USD for 35 pips, you know, although I didn't end up getting into the trade because I had made money from my GBP JPY setup, but it played out to perfection. So I feel like it is a good trade to actually show you guys today. So first of all, we're starting from the daily time frame. As you can see, right, price has been bullish. Price has been bullish on GE, but you notice something in structure here, that there was a market structure shift at this point, right? Price, this is the daily time frame, just so you know. So we are doing top down analysis right here. Price broke structure to the downside, you know. Normally, if it was going to continue, it will not fail this level, but price failed this level and kept on going down. You understand? So now engineered liquidity on the higher time frame. This took weeks to happen. It wasn't just a day. So that is how you know that, okay, if you have the higher time frame at the back of your mind, you know what you want to do on the smaller time frames. So like this engineered liquidity here as well, even on the bigger time frames. So you see that the market does the same thing over and over and over again. You just have to position yourself to catch these setups. You know, created unmitigated supply here, right? Then give us a proper week of the zone. It wicked the zone, so it showed that sellers were in control and they were about to push price lower, right? So going into the smaller time frames, I'll check the 4 hour first. So from the 4 hour, based off of our analysis, you can see everything aligns. From here, 1 second guys. So as you can see, this was the move that actually confirmed, oh okay, I think there's selling pressure in this market, right? So as you can see from here, all you want to do is just keep shorting the market, because from the higher time frame you can already confirm that okay, sellers are in the market. That was an institutional play, so you just want to continue selling based off of that signal and when it is right, because there are a lot of fake outs and a lot of things that happen at this level of the market. So on this episode, I'm going to be taking you guys into the smaller time frames, the time frames I trade as a day trader, right? Because this is still the 4 hours, and this is mainly for swing traders or position size traders that want to hold trades for maybe days or sometimes weeks. So I'm going to my territory, which is the day trading territory. So I hold my trades for minutes, maybe a couple hours sometimes, but never more than a day. You understand? So yeah, now going into the smaller time frames, I already know my bias. My bias is for sales, right? My bias is for sales. So I want to show you how you can spot volume. For the first one is volume and candlesticks. If you notice these moves are volume candles. You can see how big the wicks are, the bodies of the candlesticks are, and also this wick shows high volume in the market, high volume from institutional players. You know, that means that the selling pressure is strong. If you also look at the candles are large. That is volume as well. So you see how they come together to play like a roulette with each other. Like volume and candlesticks go together, right? So also, Killzones don't matter much on the bigger time frame, but that is why I'm taking you guys into my territory now, which is the tinier time frames. This is where I play now, right? This is the 15-minute time frame. You see these zones marked in blue, they are called the Asian session, and if you notice, they are always ranging. Most of the time they are usually areas of liquidity for people like us, the day traders, to grab. You understand? If you notice, liquidity sitting here, liquidity sitting here, same thing. So the market is always looking to grab Asian liquidity. I mean, traders like me especially are always looking to grab liquidity from zones like that, right? So the next thing we want to cover now, as you can see, the time of the day, which is the kill zones, is another very important thing. This was the trade I took today, which will be taken into consideration. Beautiful trade. This was a 2.9 RR trade on GBP USD. If you guys notice, this was yesterday, 7th of October 2025. Then this was Asia. I know that after Asia, the next thing is London, right? So if you notice, what London did first was take out this Asian low liquidity sitting here. That was the first thing London did, right? And this is pre-London. So pre-London first took out Asian low, then went all the way, right? Consolidated around this place to create an engineered liquidity, right? It didn't take out the high immediately. It also engineered more liquidity around that point to be taken out later, maybe for early sellers that thought this was probably a demand level. So market tricked them and also took out more liquidity for the uninformed traders. So because I know, I waited and saw that, oh okay, price is just trying to trick new traders or uninformed traders into the trade. So I waited for the kill zone, guys. So if you notice, it was 2 o'clock British Standard Time. Let me use this to show you guys Killzone starts somewhere around here, right, and ends around by 5 o'clock. 1 second, guys. Let me see, somewhere around there. This is Killzone. Literally, this is the New York Killzone. This is the strongest time of the day, time window of the day, basically. So this time now, that is where price moves the quickest. That is where there is the most volume in the market, right? So if you notice what happened here, this was a resting demand and resting supply based off of the knowledge we had prior. You guys understand that? Based on the knowledge we had prior, that price is bearish anyways. So we are only looking for sales in this market, right? So price has engineered this liquidity, took it out, came back to this our supply zone, then gave us a voluminous break of the candle. That brings me to my next topic, which is BOC. BOC means when you have an engulfing like this, or when you see something of this nature, anything like this that shows you volume and shows you candlestick that is very like volatile like that, and it fully engulfs the previous predecessing candle, that shows that okay, that is the break of the candle. You understand what I mean? So what happened here now was price gave me a BOC. Entering here means that you are late, so you had to go back to the 5 minutes to try to get a cool break of the candle. You know, on the 5 minute, this is what you call the kill zone. This is an ideal entry. If you entered here, that was like the best entry one can actually get. A good break of the candle, then the rest is history, literally. So that is that for catching a kill zone or trading within a kill zone. So this was the perfect example of the New York kill zone, which was caught, and that was like 35 pips. So the next concepts I would still like to touch on are the art of entry, exit, and risk to reward. And that should be all for this episode. So on the last and final segment of today's chart work, I want to show you how you enter, exit trade, and also risk to reward. Of course, I'm going to cover risk management in another separate video, like the art of risk management. But in this video, I just want to show you how to calculate your risk to reward, then how to enter a trade, what you see that makes you enter a trade. So on this example, I want to use GBP JPY, also known as GJ. As you can see, this was a setup from yesterday, Tuesday, 7th October 2025. So this is the 15-minute time frame. There was a break of structure, price went up. This was the Asian low, Asian high, waiting to be taken out. First was taken out during pre-London. It faked buyers into this trade thinking, okay, price is about to start moving forward or moving upwards, but no, came back. So they were liquidity. The traders that got in early, they were liquidity. Price came back, created more liquidity, engineered liquidity beneath this demand zone. Already from the higher time frame, we already know that price is bullish, right? So what we're waiting to see is just for price to continue to the upside and give us an entry. All of these are market manipulations, basically. As you can see from here, this was the break of the candle, so a lot of traders got in here early, right? And what happened afterwards? If you could replay price came back and stopped them out really quickly, right? Price went back to this mini supply zone just to send price back into this demand level. But this demand was the main move of the day. All of this was just stored to fuel this particular move, right? If you notice, when the trade happened, it happened during kill zone from 2. If you look at the time frame, timestamps. This was the Q zone trade. So the main trades happen during Q zone. What will make you enter this trade really is, if you look here on the 15-minute, this was a full morning star, or you can, this is a morning star, but you can call it a bearish engulfing because this is more like a indecision candle, right? So this indecision, then this bullish break of the candle made you, in a normal scenario, will make you know that, okay, this is a trade I need to be getting into, this is a trade I need to enter. So you enter on this kind of trades without thinking, then put your stops beneath this point, right? That is for the art of entry. Set your take profit. No, ideally your take profit should be Asian highs. Anytime you see such a setup and the Asian highs have not been taken out, know that price is targeting that liquidity, because remember, institutions hunt for liquidity. That is what drives the market, liquidity. Somebody's SL is your take profit. That is how you make money. So understand that, right? So in an ideal scenario, this would be my TP. But because I wanted to just make my money real quick and follow my rules as well, because I like to keep my risk parameter anywhere between 2 to 3 R. I don't go more than 3 R, but my ideal setup is 2 R. That's what I do. Then I manage my risk and go about my day, right? So for risk to reward, the last but the final, before I start that, you can see how far price went, right? But this had some fundamental reasoning to it because of what I explained earlier about the GBP JPY, right, and the Prime Minister situation. But price went all the way for a lot of pips, you know. So looking back here now, risk to reward is what helps you stay on the positive side of things, right? If you lost here, if I lost this trade, I would have lost 13 pips. But I managed to gain 50 pips on this trade because I knew how the risk to reward ratio works. My win rate is around 50%. I win 50% of the trades I take, 50 to 60%. My win rate is not great. I win 50%, but because my risk to reward is good, I go for at least 2R per trade. Every trade 2R. I'm risking twice. So I'm hoping to gain twice of what I'm risking. That's what I mean by 2R. 3R means I'm hoping to gain 3 times of what I'm risking. So for every risk, you should expect double of your risk as a reward. That is basically risk to reward. And this is the position. This is a tool called the position tool. If you look here, you drag it out. This is the long tool, long position tool, right? So when you drag it out, you can see that it has the target, it has a stop, and your entry point, and it can already calculate for you the risk to reward ratio. As you can see in this one, this is 3.95 RR, which is great. You get me? So that's basically everything in a nutshell. I've shown you guys. I'm getting into the nitty-gritty of the technical analysis, and for everybody following, make sure to practice on your own, get materials, test on demo as well. You know, just make sure you get into the markets and have a greater understanding of it. That is how you get better, by practicing, you know. But for the sake of this video, make sure to always come back, and anything you don't understand, that's why this material is going to be live forever, basically. So I think that's the end of this this chat work episode. So see you on the other side, guys. Peace. I know that was another extremely long video, but anybody that stayed till the end, that is exactly the reason why you're going to make it on your journey. It's not rocket science, it's just muscle memory. The more you keep doing it, the better you become. So bringing these concepts together marks the point where you move from student to practitioner. The trend provides direction, top-down analysis builds the narrative, narrative, volume and candles expose intent, Killzones provide timing, break of structure, change of character, and break of the candle deliver confirmation, risk to reward ties it all together. The combination is not about chasing trades, it's about positioning yourself in harmony with the market. It's not about predicting, but about aligning. That's the difference between gambling and trading. Your first trade built with this framework is more than an entry on a chart. It's a statement that you understand the market's language and are ready to respond with precision. If this episode helped you in any way, helped you see how all the pieces of trading fit into one complete framework, make sure to like this video, subscribe, and turn on the notifications so you don't miss what's next to come. Drop a comment below. What part of this blueprint do you feel strongest in, and what parts do you need to sharpen? And as always, remember, keep practicing, keep getting better as a trader, stay disciplined, and play the game to win. See you in the next one, guys. Peace and love.